Thus, actual rates are excessively high. I concur. The dollar has been plummeting. Everything seems to be, we ought to have reduced rates, but the long end is not. Come down and rates themselves. The yield curves had a bear steepener. Does this evolve? Will our rates decline? I don't believe we reach complete recession in this cycle. It doesn't really matter. Given the lag consequences, we have low growth, and inflation will be down for some time. When do rates drop? What makes them so sticky? Though inflation hasn't been particularly persistent, it's only returned down as usual. We are in a really crucial time in financial history. We are on uncharted waters, large international tariffs, significant government income flowing into the United States of America. At this time, inflation is decreasing, but the Federal Reserve of the United States flatly rejects lowering interest rates even though the dollar is losing value and inflation is naturally declining. Given all of that, how will this affect XRP and the future price movement? It's going to have significant consequences in many various respects, so you all surely will want to hear. Raoul himself will dissect it. I thus wish to provide you, everyone, the chance to hear and take in this beneficial knowledge so we can all earn a great deal of money together. But more on that later. Let's listen to Raoul. I suppose it's a liquidity issue, correct? First off, when you consider the brand that Fat Farms or so for futures, it's typically a fairly good guess by traders on what the Fed will do next few meetings, and they often price very reasonably based on the speculation, thinking at 20 or 30-year bonds as an asset, and when they lose value, it simply indicates more sellers than buyers. That has nothing to do with. I don't think things like Trump premium fair value for bonds exist. Think and see. It's been 27 years in the marketplace. Trump premium still eludes me. Everyone discusses it. No one can tell me what it means. This is sort of again, going back to buy low, sell high. You have to remember when the price is at the level when buyers smash sellers. That is a mythological term, premium balance. Well, this is called the Trump effect. Indeed, it is quite genuine. You never truly know what Trump will be doing one day to the next. Still, I believe there is one very crucial issue going on right now that many of you should be aware of, and that is the reality that Trump's tariff announcements are causing markets to become desensitized. What we began to observe is that when Trump discusses tariffs, people don't care as much as they did before, since they are beginning to understand, well, if monetary supply is rising, which it is, in the Eurozone, in North America and Canada, in Australia, all the major economies in the world, well, yeah, that's all that really counts. M2 rises, so do prices of crypto assets. Moreover, there is a quite intriguing correlation at the moment. Monetary supply only increased 5 trillion. Though it is falling behind, Bitcoin has been experiencing a fair bit of price rise, as you all have most likely noted. Once again, we exceeded 95,000 and have been fluctuating around that mark for very some time. XRP also surpassed $2.20 per coin, roughly the same time. Now the agreement is this. XRP will once again be testing all-time highs as well. Bitcoin is quite likely to reach new all-time highs in the coming few weeks. So if you're searching for a $3 or beyond for XRP, now is the moment for you to pack your things and prepare. Still, I believe one other event now taking place merits great attention. Therefore, I want to quickly play this Raoul clip right here. Then we'll discuss its significance. When there are more sellers and purchasers, I'm just saying, okay, less liquidity, less people able to buy this asset, more individuals who need to sell this asset, and susceptible assets get sold. One of the things I was really considering during the last several days that you have to grasp, and I believe what is going on is front-running the next event that is occurring. Therefore, for better or for worse, the tariffs are meant to lower the present account deficit directly in the United States. But what does lowering current account deficit entail? That implies foreign nations will buy less goods from the United States and receive less dollars. Sure, what does it mean? They will have fewer dollars to purchase US assets with. Lower present account deficit therefore unavoidably results in a lower capital account surplus, since it is an accounting equation. They must be equal to one another. That might be replaced by local purchasing? I don't get how. So it is natural to kind of, what I feel, that this recent move was a little bit of front-running of this current account conundrum. Sure, and we have no idea if tariffs would actually affect the trade deficit, current account deficit, or any other area of uncertainty. It's all just guesswork. We don't know, hence it's more difficult to picture their desire since. Usually if you pack something, you get less of it. If you subsidize something, you get more of it. So once more, if you tax import, you'll receive less of them. That appears to be rather simple. Therefore, I fail to understand how adding carrots will aggravate present accounts. Let us say it this way. Then consequently, for them to let the bond market clear at fair prices, it's a question of pushing the pension sector, the insurance sector, or the banking sector to hold more bonds. Sure. The step has already been made toward this alteration in this. What does this call this? SLR exemption, whichever. Additional leverage ratio. Longer, I have supported the idea that apart from quantitating, easing, and modifying the federal funds target, there are truly three more approaches. Changing a titan's banking rules in general is another approach to help them. That's a really straightforward approach to relieve a monster. Paradoxically, if the Fed desires this for the government is by losing. I mean, I don't know whether you've been following Basel IV, but Basel IV, which started getting implemented in Europe this year, and just in. So, indeed, incredibly crucial issue once more. This is the dynamic now in play. And it's quite reasonable one at that. Basically, the more you tax foreign countries like China, Europe, and all their imports coming into the United States of America, the less your trade with them will decline, which will reduce the incentive for people worldwide to keep the US dollar. And so they will not. They are also likely to sell some of their bonds. We do know, for instance, that Europe, China, and Japan all hold a great deal of US bonds. Since their present economies are quite linked to the United States, hence selling, this will harm their own economy since they depend on the US buying their goods en masse. So they'll experience an economic slump. The United States probably will experience an economic decline as well, which will generate a lower dollar since less people are spending it. Much like with XRP, for instance, or other cryptocurrencies,